Thanks for joining us today on this month's Market Compass. Well, after a sharp and steady rally that started last fall, markets have sputtered in the last few weeks. The pullback has been rather benign, but it's introduced a phase of volatility as the market's growing optimism has now been challenged by emerging geopolitical uncertainties and the prospects of interest rates staying high for longer than hoped. So is this just a speed bump, or is the stock market running out of gas? Well, we think the answer to that lies within the responses to three important questions. Are we in a bubble? Is what got us this far going to get us further? And what's ahead, more potholes or more open road? We're going to dive deeper into these questions and more after the break. Let's start with the broad question of, are we in a bubble? Now that may seem like a silly question, but when we entered April with the stock market on a tear, stocks had risen sharply and steadily over the last 5 months, logging a gain of 27% from the end of October to the beginning of April, ascending to a string of new all-time highs. But it's been not only the size and speed of those gains, but also the driving force behind them, that driving force being the run-up in technology, that's drawn comparisons to prior overheated markets. That sharp run-up in technology, most notably the mania around artificial intelligence, does look to us to have shades of euphoria. Not because the future impacts of AI on the economy are misguided or even overstated, but simply looking at the price appreciation of certain technology investments, and maybe to a lesser extent the market as a whole, does at least warrant some attention in our view. So the better than 20% return in the stock market over the last year has been powered, importantly, by a 50% gain from the tech sector, a dynamic that does really harken back to the 1990s. But more concrete comparisons to the tech bubble are, to us, both premature and a bit overstated. First, while last year's stock market gain looks similar to the calendar year gains that we saw during the late 1990s, it shouldn't be lost that the dot-com bubble was filled by 5 consecutive years of annual returns exceeding 20%. Impressive to say the least. Perhaps more importantly, earnings across the dot-com stocks back then didn't back up those gains. In the 1990s, meteoric gains were occurring in unprofitable dot-com companies, many of which had tantalizing growth prospects but no real viable or sustainable earnings base. Today, on the other hand, the enthusiasm is concentrated in the largest companies with prolific as well as what we would call defensible earnings. So let's take Nvidia, Microsoft, Alphabet, or Google as we know it, Amazon, and Meta. Those companies generated a combined $250 billion in earnings in 2023 alone. So, could we see slivers of reckoning in this most overheated space of the market? Of course. Does this raise the potential for disappointments that spark temporary pullbacks? Yeah. Does this pose a more structural threat that sends the overall equity market into a sharp or severe dive? We don't think so. Now the question becomes, is what got us this far going to get us further? So this current bull market officially began in October of 2022, which seems like a lifetime ago, with the latest stage of this expansion shifting to a higher gear over the last several months. The recent spate of gains has been driven by a few key factors: rising valuations, rising expectations for near-term Fed rate cuts, and the excitement over technology and AI that's powered significant leadership from certain pockets of the market. Looking ahead, I think there will be a key shift in a few of these drivers, with the main fuel sources being earnings growth, less restrictive monetary policy and lower rates, and the broadening out of the overall bull market. Let's start with valuations. So valuations rose last year in anticipation of corporate profit growth ahead. We don't think those expectations are misplaced. We expect rising earnings will be an important pillar of support as we move through 2024, with overall stock market gains likely approximating the pace of earnings per share growth. We noted that expectations for Fed rate cuts have been a key element of recent gains. The pace of improvement in inflation has slowed in recent months. That much has been clear in the last few months of CPI reports, which has pushed back the timetable for when the Fed is likely to initiate an initial interest rate cut. That's been the catalyst for the recent dip in stocks, ironically also the catalyst for the rise in stocks that we saw that started last October. So while we don't think the Fed will move to the back seat in terms of the influence for the overall markets, we do think that the focus will shift from simply the timing of a rate cut to the trends in inflation and economic growth ahead that transpire as the Fed remains on hold a little while longer. And in terms of market leadership, we think we'll see some areas narrow the gap with technology and play a larger role in driving performance ahead. Last year, the majority of the S&P 500's gain was attributable to just a small number of mega-cap technology stocks. Interestingly, with the top 10 stocks in the index growing to represent almost 30% of the S&P 500's total market cap, which raised the concentration and narrowed leadership. As the bull market advances, we think some of the lagging sector and asset classes will play catch-up. This broadening out of the gains will, in our view, be a healthy trend that can support the bull market's longevity. Now let's look out to the horizon. Is there more open road ahead, or should we expect more potholes? Well, investors should expect a bumpier ride than we've experienced of late. To us, inflation and geopolitical tensions are the most prevalent threats, and as the election gets into full swing, political uncertainties here at home will likely add to some bouts of anxiety. But keep in mind, even the healthiest of markets experience regular pullbacks, with stocks historically averaging 2 5% dips and 1 10% correction per year. Importantly, however, we think the stock market has more room to run. While the market has dipped a bit here in April, it shouldn't be lost that we entered the month on the back of a string of record highs, with the market eclipsing its previous high watermark in January. The upshot? Well, history shows that bull markets don't tend to run out of gas after hitting new highs. In fact, 4 of the last 5 instances saw stocks rise at least 40% beyond their previous peak. So while we think there's plenty of mileage left in this bull market, a potentially windier path ahead warrants a more disciplined strategy as well as an opportunistic approach, as we think bouts of market weakness can present compelling buying and rebalancing opportunities. Your Edward Jones financial advisor can help you design and execute your plan to keep you on the road to your financial goals. There's rarely perfect clarity when it comes to the investment markets. But what's clear to us is that market conditions are going to remain dynamic over the balance of this year. Tune back into next month's Market Compass, where we'll continue to dive deeper into these topics to keep you on track.